It's a body blow for Paytm, no doubt. Shutters down on their banking ambitions, at least for now, with no visibility on when RBI may lift the embargo. Paytm has lost nearly 19,000 crore rupees in market cap in just the last two trading sessions, now trading at 487 a share, not too far away from their all-time low of 438 rupees and down almost 75% from the listing price of 1950 rupees a share. Now, citing persistent non-compliance, continued material supervisory concerns in the bank, RBI has asked the payment bank to stop onboarding any new customers. No further deposits, credit transactions, wallet top-ups, etc. are going to be allowed after the 29th of February. No banking whatsoever. That is the message from RBI. So we've been talking to various sources to understand why this unprecedented action was taken against Paytm, and it appears that there were two major reasons. One, repeated instances of failure to comply with RBI directions on strengthening specifically the KYC processes. There were lapses in transaction monitoring and alerts, and that could have led to concerns about money laundering and frauds by miscreants that were able to game the system. And after multiple warnings and even barring the bank from onboarding any new customers back in March of 2022, this action was taken by RBI. The second major concern RBI seems to have had is also linked to the shareholding pattern of the payment bank and potential conflict of interest there, because there was no real arm's length distance maintained between the bank and other entities of Paytm, with high interdependence and potential related party transactions. That also, we understand, raised an alarm with RBI, although the management has denied that, because if you look at the shareholding pattern, Vijay Shekhar Sharma in his personal capacity owns 51% and 49% stake in the bank is held by 197. Now, Paytm in its con call to analysts did not give any clear explanation as to why RBI took this action or when, more importantly, this restriction will be lifted. Vijay Shekhar Sharma called it a big speed bump, but one that Paytm will be able to navigate. But lending part of the business may take a backseat, with no new loans being originated at least for a couple of weeks. That was the message from the CFO. The annual EBITDA hit, according to Paytm, is estimated at 300 to 500 crore rupees. Now, brokerages are negative on the stock. You have the likes of Bernstein saying that this ends the operations of the bank for all practical purposes. Macquarie has even likened the action to RBI indirectly revoking the PPI license, and Jefferies has downgraded the stock to underperform, estimating a significant hit to EBITDA. Now, in terms of what lies ahead for Paytm, one, there is no clarity on when RBI will lift this embargo. Number two, the regulatory overhang may impact the lending partnerships of Paytm as well. There's also going to be a question mark on its ability, if at all it wanted to convert into a small finance bank, because the money really is in lending, it's not so much in payments. So that dream, if it had one, could be dead. But most importantly, the street is worried if RBI may not be done with its penalties just yet.